Welcome everyone to the podcast of Grant Thornton Uganda, and I am Bhumi Patel, your host for today's episode. I'm delighted as we unpack one of the most important yet often misunderstood areas of taxation in Uganda, withholding tax, commonly referred to as WHT. For many businesses and individuals, WHT can sometimes feel very complex or even confusing. Questions often arise around why it exists, who is required to withhold, when it applies, and how exemptions work in practice. Yet, understanding withholding tax is critical because it affects day-to-day business transactions, compliance obligations, cash flows, and relationships between taxpayers and Uganda Revenue Authority. Today, we shall simplify the conversation and take a practical look at how withholding tax works in Uganda, the purpose behind it, common challenges taxpayers face, and most importantly, how withholding exemptions operate in real business situations. To help us navigate this discussion, I'm pleased to be joined by our guest speaker, Bruno Amanya, Senior Associate Tax at Grant Thornton Uganda, who brings extensive experience and insight in the field of taxation and tax compliance. So Bruno, thank you for joining us here today, and let's get into the conversation. Let's start from the very beginning. What is withholding tax and why does it exist?
Thank you so much, Bhumi. Withholding tax is a collection mechanism. It's a collection mechanism for the Uganda Revenue Authority that is established by the Ugandan income tax laws. So the way it works is that basically when someone is earning a certain amount of income, the law says that when the person is being paid, the payer is required to withhold a certain fraction of that money and give it to the Uganda Revenue Authority. That money that is withheld, that money that is deducted, is the withholding tax. You see, without this mechanism, UAE would face a really big challenge. You see, our country is an informal country. There are millions of people who are earning revenue, who are earning income on a day-to-day basis. It would be very difficult for UAE to find each and every person who is earning money. It would be hard also, it would be administratively costly for UAE to look for each and every person. Think of an organization that employs close to 5,000 people. If UAE is to look for each and every one of those personnel, each one of those employees, it would be a very tall feat. So the withholding tax mechanism comes in to ease UAE's collection mandate by just requiring them to go for the person who is making the payment to all these 5,000 people and telling that person, withhold a certain fraction from each employee and remit it to UAE. The beauty of it is that in most payments, that amount that is withheld becomes a credit to the person who receives that money. So if I am a consultant and you hire me and you're supposed to pay me, let's say, 100 million, you are required to withhold 6%. So you will withhold 6% and pay me 94 million. That 6% you give it to URA, and then I would receive 94 million, but in my declaration, I'll say I have received 100 million. Now, on that 100 million, I'm supposed to pay, let's say 30%. So on that 30%, I am allowed to deduct the 6% you took away and gave to URA. So that's how it works. However, there are unique circumstances where the withholding tax can be a final tax. We need to understand that the very logic of withholding tax is to catch those payments that would be administratively challenging for URA to collect. So when the law says that this withholding tax is a final tax, meaning that it's the last point of taxation, it means that that money is very hard to trace to the person who's receiving it. A good example relates to foreign suppliers. So the foreign suppliers, it will be hard for you to go to, let's say, China to find the foreign supplier and tax them. So they say the person who's paying, let them deduct. So all in all, the withholding tax mechanism is more of a collection mechanism to collect an advance income tax from the person who is paying, but the tax is directed to the person who's receiving the money. Yes.
Does that mean every payment I make should attract withholding tax?
Not quite. You see, we need to understand the logic behind it. The logic behind it is withhold on payments that are hard to trace. And the law acknowledges certain payments are hard to trace. Like we talked about the employees. The employers that have a lot of employees, it would be hard to trace each and every employee and enforce against each and every employee. To the foreigners, it would be hard to trace each and every one of those foreigners. So the law sets out certain types of payments where withholding would be required. So it's not every payment, it's the payments that are specifically set out in the law that state that when you're making such and such a payment, you're required to withhold.
So technically the tax is onto the person receiving the payment. If I fail to withhold, should an URA pursue them instead of me?
That's a good question. It's a very good question because, you see, in other jurisdictions, in other countries, that has been argued and successfully at that. And it makes sense because the person receiving the money would receive 100% and they would declare 30%. It makes less sense to require the person to withhold when the person who's receiving the money is declaring the full tax on it. There's some argument there, but in Uganda's tax law, it is very specific that when you're required to withhold and you don't withhold, you become personally liable. If you look at it also, it makes sense because it makes URA's work easier. Yes? So if URA comes for you and you did not withhold, it is more challenging for them now to look for the person who you paid. It is easier to come for you because they know you, because you're going to claim that cost as an expense, as a purchase in your books. So it's easier for them to come for you because that expense is helping you to reduce on your tax liability. So they're going to say, on that expense you declared, you should have withheld. If you didn't withhold, you're personally liable. So you're going to pay us the withholding tax you should have withheld. Interestingly, if you pay that tax and you had given the supplier the full 100%, you are entitled to go to that supplier and claim back that tax you paid. Because that supplier would have paid the full 30%, and then by you paying, he would be getting a credit. So he would not be entitled to that credit. You get it? So you can claim it. You can tell the supplier, give me back my money. However, that can be a very awkward business conversation, like, oh, you know that money I gave you last time, give me back a portion. So the law does give such avenue that in case you are personally liable, you can claim it, yes.
Now that we understand the basics of withholding tax, maybe we could now proceed to withholding exemptions, which is something that many taxpayers look forward to knowing about. Could you tell us more about it?
Yes, you see, withholding tax as a mechanism, it has separate exemptions. It has different exemptions. There are mainly three types of exemptions that you can find from withholding tax. The first one is the specific exemption that is stated in the law that when this supply or import happens, there is no withholding tax required. That is commonly seen with agricultural supplies. So if I'm a supplier of agricultural supplies or importer of agricultural supplies, there would be no withholding tax obligation. There is another exemption that is in the law. That withholding tax exemption is attached to the income tax exemption. So basically, if you are exempted from income tax, then automatically there should be no withholding on you. For example, as an employee, if the law says that you as an employee, you're not required to be taxed on your employment income, that means your employer would not need to withhold from you. So by that nature, you are exempted from withholding tax. Then the last one, which relates to the notice you talked about, is the withholding tax exemption that is granted upon URA's satisfaction. This one is a discretionarily given exemption, whereby URA looks at your compliance and determines whether you qualify, and then they give you and you become withholding tax exempt. Yes.
I get it. This sounds quite different from the normal exemptions that are available from URA. Could you tell us why this exemption is unique?
Yes, it's unique because, like I said, it's based off URA's satisfaction. The law says that URA has to be satisfied that you have been regularly compliant with the law, meaning that you've been filing your returns as and when you're required, you've been paying the tax as and when you're required, you've been declaring payee, withholding tax, you've been basically a good citizen in URA's eyes. So URA will have to first do a compliance check on you based off the different criteria that are set out in that notice. So that notice basically says that if you meet all these requirements, we are satisfied that you are entitled to the exemption. So when URA checks you and grants you the exemption, you're exempt. This exemption, I should say that it relates to certain payments. Payments made by government entities or government institutions or designated withholding tax agents which exceed 1 million or more made to any person in Uganda. It also relates at importation of goods. So when I import my goods, the payment, the customs value, ordinarily I would have to pay a withholding tax at 6%. So, but when I have that exemption, I don't have to. Then lastly, it also applies to payments made to local professionals or consultants. If that local professional has that exemption, I don't have to withhold. So that's what makes that exemption very unique, that it's subject to your satisfaction and it relates to specific payments.
Now that we know that this tax exemption is very important for all taxpayers in Uganda, I'm sure the audience would want to know that are these exemptions temporary or permanent?
This exemption is usually periodical. URA gives it for a specific period. So after the period elapses, the exemption elapses, so you have to apply again and meet the criteria set by URA then. So previously, the exemption has run for a year. So URA checks you, and if they are satisfied that you're fully compliant, they give you the exemption for 1 year. However, with this coming financial year, the exemption has now been shortened to 6 months. So after 6 months, you would have to apply again, and URA would have to review again. Yes.
Can URA simply reduce a period like that?
Technically, yes, because like I said, the exemption is subject to their satisfaction. So if I were URA, I would argue that I need to be satisfied that you are regularly compliant. And to do that, I need to do periodical reviews of your compliance. And to do that, I need to do it after every 6 months. So it's within URA's discretion. So yes, they can reduce the period like that.
Let's make this more practical for our audience watching us. What does obtaining this exemption really mean in practice?
Suppose you're a consultant and you have a customer and the customer is supposed to pay you, let's say, 100 million. Without this exemption, that customer would be required to withhold that 6% and remit it to URA. But when you have attained that exemption, you will tell your customer that, look, this is my invoice, but I am exempt. And you would show them the certificate showing that you are exempt. When the customer is fully aware that you're exempt, they would not need to withhold, they just pay you the full 100% of your revenue. Yes, so it means that you would have more money coming in and it would also improve your cash flow as the consultant. Yeah.
So that means every taxpayer will have to go through an exemption application to be able to successfully get exempted from withholding tax. What challenges do you think may arise while, during the application process?
The central issue is that URA has to be satisfied that you're compliant. So URA can, in their discretion, determine whether in their discretion, they would have to determine whether you are compliant. Now, the issues that come in are what exactly is compliance to URA? What do they consider compliance? That can be the issue. In previous years, we've seen URA rejecting these exemptions based off issues of supposed non-compliance. For example, ledger issues, where someone's ledger has assessments. And so they said, because your ledger has assessments, there's an issue of non-compliance somewhere. But if you're to talk to the taxpayer, they would tell you that my ledger has no issue. It's a payment allocation issue with the ledger. As far as I'm concerned, I've always paid my tax on time. So sometimes the ledgers do not reflect the true tax position of the taxpayer. That can create an issue. The other issue is deemed director's income. So in the past, we've also seen situations where URA would look at a director of a company, and they'll look at the director and they say that this director you've declared, he's earning, let's say, 1 million. But then they would say, a company of your size, how is a director earning 1 million? It's impossible. So they would say that this director should be earning 4 million. So that difference, that 3 million, they can say that you're not declaring the director's true income, so you're not being compliant with your declaration. And because of that, they decline your exemption. So in such situations, issues can arise, disputes can come up, and that is something that we've seen previously happening. In the coming season of the application, of the exemption application, we are seeing on UIS checklist that was put out in their notice, they do have unique compliance checks. One key one that I off the top of my head is the minimum revenue contribution, where they require a taxpayer to contribute a certain amount to the tax revenue, depending on their status. So if it's a small taxpayer, UIA expects that taxpayer to contribute at least 100 million to the tax revenue. If it's a medium, 200 million. If it's a large taxpayer, 500 million. So an issue could come up where a taxpayer would say, the law says that you have to be satisfied that I am fully compliant with the law. That means, as far as the law is concerned, whatever the law says, I must be in tandem with that law. So the taxpayer would ask, where in the law does it say that I have to contribute a tax revenue of 100 million to you? So that can be an issue that can come up. And if a taxpayer was to raise it, they would have a good argument there. They would have a good point right there. So those are the small issues. The central issue is generally, what does URA consider compliance?
Interesting. If URA rejects an exemption application, what should taxpayers do?
I would say, first understand why. Not every rejection is URA coming for you. Sometimes the rejection comes from a genuine non-compliance issue. Perhaps a return was filed late, perhaps an assessment wasn't paid, perhaps there's still something wrong with your books, there's something wrong with your declarations. So first understand why they've rejected your exemption. Actually, as GT, we advise to first do a compliance check before you go for the application. First do an internal compliance check to check that, how is my filing history? Do I have any pending assessments? Have I cleared those assessments? Am I objecting to these assessments? What's going on before you apply? So once you confirm your compliance check, then you can apply. If URA rejects based off a non-compliance issue, you can resolve it and apply again. Okay? However, there are some times where the rejection is based off a point of law. Like I said earlier, URA has to be convinced that you're compliant with the law. So if URA's understanding of a certain compliance requirement does not conform to what the law says, there can be a bit of pushback. In such a situation, the taxpayer can object to that rejection or take the matter to the Tax Appeals Tribunal, because that rejection is a taxation decision that can be disputed.
Before we wrap up, any advice for our dear audience?
I'd leave the audience with 3 points. The first point is, if you're going to make a payment to a professional, to a foreigner, to anyone, first ask yourself, do I need to withhold? First understand, does the withholding apply to me? If it does apply to you, then you have to do a little bit of due diligence. Confirm if this person is exempt from withholding tax. If they say they are exempt, request for an exemption certificate. Because at the end of it all, URA will come for you because you're going to claim that expense, and URA is going to say, this expense you didn't withhold. The best defense you have for yourself is that I didn't withhold because this person was exempt at the time. So attain that exemption certificate, keep it in your records. Or you can go to the URA website. The exemption list is always listed. It's always there. So you can always check for that taxpayer and ensure that they are exempt. 2, if you are the person receiving the payment and your customer withheld from you, always ensure that you get that withholding certificate also from them. Because when they withhold from you and declare in their returns, they can extract a withholding tax certificate. That certificate you can use to claim your credits. At times, that credit does not reflect in your ledgers. It does not reflect anywhere. So that certificate goes a mile away. When you take it to your and you tell them, look, this human being withheld from me, this company withheld from me. So I'm entitled to this credit. And URA will have to effect that credit in your ledgers. Then lastly, because the compliance can become a bit tricky sometimes, and URA can raise a few red flags, we always advise that you always seek professional guidance, especially to make sure that you are clean before you apply. Because sometimes you may apply and URA checks and another issue comes up, a wholly independent issue comes up. So it's best to first do a background check on yourself, a tax health check on yourself to confirm that you are compliant, then you apply. Yes, thank you.
As we come to an end of today's discussion, I would like to sincerely thank our guest speaker, Bruno Amanya, for sharing such valuable and practical insights on withholding tax in Uganda. We hope that this conversation has helped simplify how withholding works, why it exists, and shed more light on some of the practical issues surrounding withholding tax obligations and exemptions. One key takeaway from today's discussion is that withholding tax is not just a compliance requirement. It is an important part of Uganda's tax administration system. Understanding it properly helps businesses remain compliant, avoid unnecessary penalties and disputes, and better manage their cash flows. To everyone who's tuned in and watched, thank you for being part of this conversation. We encourage you to continue engaging with the tax professionals and staying updated on tax developments to support informed decision-making and compliance. If you have any questions or would like further guidance on WHT or any other tax matters, please feel free to reach out to us at info@ug.gt.com. Follow us for more conversations on tax, business, and regulatory matters. Until next time, thank you for watching and have a great day.